What if I told you China could crash the stock markets without firing a single bullet? All they'd have to do is this: sell US Treasury bonds, and if that happens, it could hit your 401k, stocks, tech portfolio, even mortgage rates. So let's break it down in plain English. What would actually happen if China started dumping US Treasuries? China owns hundreds of billions in US Treasury bonds. That means China is basically one of America's biggest lenders, and when they hold treasuries, they're helping keep US interest rates lower. But if they start selling, that creates a chain reaction, and that chain reaction can hit the stock market like a wrecking ball. Here's the first rule of bonds. When a ton of bonds get sold, prices fall, and when bond prices fall, yields rise. So if China dumps treasuries into the market, treasury yields spike upward, and that's where the real trouble begins, because treasury yields are the foundation of the entire financial system. They influence mortgages, business loans, car loans, credit card rates, and stock market valuations. So higher yields doesn't just affect bonds, it affects everything. If treasury yields spike, the US government must offer higher interest rates to attract buyers. Translation: the US has to pay more interest on its debt, and that means higher federal borrowing costs, higher consumer interest rates, higher mortgage rates. So your average American feels it quickly. Suddenly, mortgages go up, car loans get more expensive, credit card interest explodes, and consumer spending slows down. Now let's talk stocks. The stock market hates rising interest rates, because when rates go up, investors demand higher returns, companies face higher debt payments, future earnings become worth less today. That causes valuations to compress, so the biggest losers are usually tech stocks: Apple, Tesla, Nvidia, Microsoft, Amazon. These are growth stocks priced for the future. When yields rise, that future gets discounted harder. Result: tech drops first, and usually drops hardest. If China sells treasuries, they get dollars. Then they might convert those dollars into yuan, gold, other currencies, commodities that could weaken the US dollar, and a weaker dollar can cause higher import costs, inflation pressure. So now you have the worst combo: higher yields plus inflation pressure. That's a toxic environment for stocks, because the Fed might be forced to keep rates higher longer. Here's where things get interesting. If yields spike too fast, the Fed may step in. The Fed could start buying treasuries to stabilize the bond market. This is basically money injection. So the Fed would be choosing between option A, let yields spike and risk a market crash. Option B, buy treasuries, stabilize yields, but risk inflation. Either way, markets get shaky. That's why big treasury sell-offs cause panic, because investors know the Fed gets forced into a corner. Could it crash the market? Potentially, yes. But here's the truth. China dumping treasuries would hurt China too, because if they sell aggressively, bond prices drop. Their remaining holdings lose value. Global markets destabilize. Exports slow down. So it's like China setting off a bomb. But they're standing close enough to get hit by the blast. That's why it's unlikely they would sell all at once, but even a gradual sell-off can still cause higher yields, higher volatility, lower stock market valuations. Most likely to fall hardest: tech, NASDAQ, QQQ, growth stocks, real estate, REITs, high-debt companies, small caps, Russell 2000, sectors that might hold up better. Energy defense commodities, some value stocks, companies with strong cash flow and low debt. So, what do you do if you hear headlines like, China begins selling US Treasuries? Here's the smart checklist. 1. Watch the 10-year yield. If the 10-year yield spikes fast, stocks usually drop. 2. Expect tech weakness. When rates rise, NASDAQ is usually first to bleed. 3. Reduce leverage. High-rate environments punish margin traders. 4. Keep cash available. Volatility creates opportunity. 5. Don't panic sell good companies. If the company is profitable with low debt, it may recover quickly. So the real takeaway is this: if China dumps treasuries, the bond market reacts first, then interest rates rise, then tech stocks get crushed, and then the entire market can get pulled down with it. Treasuries are the backbone of the financial system. And if that backbone shakes, everything else shakes with it. Hear it here first. Follow and subscribe to my channel to continue to receive valuable stock buying tips, and comment below. Do you think China would ever actually dump US Treasuries?